Joining us now is six-time Graham and Dodd Award winner Rob Arnott, chairman of Research Affiliates, a global leader in innovative investing and allocation strategies that licenses over $160 billion. Rob, I have to start off giving you a victory lap here because last time we did your interview, you were very specific with the King World News global audience. You told them, go invest in SFENX. That's the Schwab Emerging Market Large Cap Fund. That fund, since January 30th, so we're talking less than 3 months here, is up 26% or more than 26%. Talk about where we are now, because that was a phenomenal recommendation on your part. Congratulations.
Sure. Thank you very much for mentioning that. It bears mention that it's gotten back to levels that we last saw only in November. That's the nature of a market bottom. When you get a capitulation, the final sell-off can be brutal, and the snapback, the early stages of a bull market, can be equally impressive. In fact, from the lows, which were hit just a week before we last spoke, this is up over 35%. Okay, so that invites the question, gee, it's up 35%. Is it too late? I don't think it is. I don't think it is for the very simple reason that I think January and February may have marked the low for a whole array of value-oriented asset classes. Value's been out of favor since 2007. Value's underperformed growth by 2.5% per year since mid-2007. That's huge. And when you get that kind of protracted secular bear market, anytime you've got a 9-year bear market in a style of investing, the turn can be the start of a multi-year bull market. So I don't know if we're going to test the lows again. That wouldn't shock me. But it also wouldn't shock me if we don't test the lows, if, in fact, this is the start of a bull market in value-oriented assets. And that would span a whole array of things, emerging market stocks and bonds, perhaps also high yield, value-oriented strategies in the stock market, fundamental index relative to the cap-weighted market, a whole array of strategies that I think are cheap relative to history and therefore are priced to offer superior forward-looking rates of return. Anyway, I see a whole array of opportunities out there. There are things that are very expensive, and most investors have most of their money in mainstream U.S. stocks and bonds. They're expensive. Most of their equity money in the U.S. is in growth stocks. They're very expensive. The rubber band between growth and value is stretched unusually far. Growth has traded richer than it is now, really only during the tech bubble. Okay, well, that's a little scary. That's not a good comparison. And so I look on this as early stages in what is likely to be a multi-year bull market in value-oriented stocks, in emerging markets, and in other diversifying asset classes.
Rob, I hate to do this to you again because you're taking a victory lap here, obviously, on SFENX, and I want to come back to that in just a minute, but do you have a ticker symbol for people around the globe that might want to try to get involved in one of your funds that will take advantage of that value-oriented growth that you expect to see going forward?
Well, really, any of the fundamental index strategies offered by a variety of our affiliates, Schwab, PIMCO, Invesco Power Shares, would be interesting. For those who want to stick to U.S. investing, Invesco Power Shares has an ETF. It's the oldest ETF based on fundamental index in the world. Dates all the way back to late 2005. Ticker is PRF. F as in Frank. And what's, I think, interesting and what I'm very proud of is that strategy, that fund, has outperformed the S&P 500 during a time when value has been savaged. I can't wait to see how it does during a time when value is winning. And so I look on that as the most interesting strategy available to us if we're going to stick with U.S. investing. I would caution that even fundamental index in the U.S. is pretty fully priced. So if there's a bear market in the U.S., yeah, it'll participate, but I think it'll cushion the downside somewhat. And if we manage over the next 2 or 3 years to continue avoiding a bear market, value is cheap. Growth stocks are expensive. So this represents, I think, a great opportunity to earn better than market returns.
You know, for the people listening globally, that's why you're such a legend, Rob, because you steer your clients out of the overvalued stuff and into where the carnage is. And last time, of course, you told the global listeners, go into SFENX. Again, that was up over 26% already in just a matter of months.
I also don't think it's too late for that one, by the way.
Well, let's talk about that a bit, because one of the things you and I both mentioned was it's kind of a double whammy, right? Because you go in and you catch the growth in these emerging markets that were absolutely savaged, but then you get the currency kicker. And I think you told me that made up 6% of those gains.
Yeah, we do relative valuation on currencies based on very simplified measure of purchasing power parity. How far does the currency go in buying goods and services around the world? And the emerging markets collectively were 25% rich relative to fair value back in 2011. 25% overpriced. Recently, they've been 25% underpriced. Going from 25% overpriced to 25% underpriced is a huge hit. And so emerging markets performance has been just awful over the last 5 years. That's what led to the bargains that we have now. And so when we look at emerging markets today, they've recovered 35% from their lows if you go with value investing like fundamental index, but they're still cheap. One of the things I like to look at is what's called a Shiller PE ratio. It's price relative to 10-year smoothed earnings. And why use 10-year smoothed earnings? Because earnings are volatile. They change from year to year. So if you smooth it over 10 years, you wind up with a much more powerful measure of whether a market is cheap or rich. And what do we find? We find that the U.S. is still trading at 25 PE based on 10-year smoothed earnings. That's pretty darned high. It's not nosebleed territory. It got to 44 times in the tech bubble, but 25 times is pretty darned expensive. It means you have to spend $25 to buy stock with just $1 of long-term average earnings. Yikes, that's a lot. Well, in emerging markets, at the low, you paid less than $10 for each dollar of earnings. Today, it's $12 for each dollar of earnings. What about fundamental index, the value-oriented strategy in emerging markets? Good gracious, that got to less than 7 times earnings. You spend $7 to buy $1 of long-term average earnings, to buy half of the world's GDP for only 7 times earnings when the U.S. is at 25 times. Of course I'm going to be bullish on that. People have described me as a perma-bear. I'm a bear on things that are fully priced or expensive. I'm a bull on things that are cheap. And emerging markets became unbelievably cheap and are now still pretty darned cheap.
Rob, I know you and I both expect a great deal of inflation going forward, and I want to tie this into what we're talking about right now. Peter Bookvar was saying that he believes commodities have bottomed, and so this is going to put the Fed in a bit of a predicament because we'll have this inflation going forward. But with regards to SFENX or some of these type of emerging market plays, you said this was just the beginning, and rather than go in and try to trade commodities where it's, riddled with chaos in those paper markets, one way to ride the inflation wave higher in commodities and other things is to be in emerging markets. They have a tremendous amount of growth during those phases, don't they?
That's exactly right. Emerging market stocks have a higher correlation with U.S. inflation than TIPS do. TIPS are the inflation-linked bonds. They're contractually linked to CPI inflation, and yet emerging market stocks have a higher correlation with inflation than they do. That's pretty amazing. So if you think inflation is likely to reignite, or even if you want to hedge against the risk that just maybe inflation will reignite, emerging market stocks and emerging markets bonds, by dint of their currency exposure, are marvelous ways to protect against renewed inflation. So where are we now in the inflation cycle? Well, headline inflation has come back from 0 to 1.5% in the last 4 or 5 months. That's a huge shift. What about returning back to zero? Not going to happen. Here's why. What caused inflation to go to zero was the energy crash. Energy falling from over $100 a barrel to under $50 a barrel in the space of 4 months. That created negative inflation, deflation in energy costs, and that rippled through and pulled the headline inflation number down to zero. Well, those months in which energy prices were crashing are rolling out of the 12-month inflation number. That's all that happened that allowed the inflation to spike back up from 0 to 1.5. What this means is that it took a crash in energy prices to push inflation down to zero. A crash in energy prices is daunting, but energy had already fallen in half. It's not going to fall by a similar margin again because that would take it to zero. And so what we're left with is renewed inflation is already on the scene. The other thing is, if you look at inflation net of food and energy, what's called core inflation, that's risen from 1.6% to 2.3% in the last 6 months. Wow, that's a big jump, and it's well over 2%, which is the target for the Fed. So I do agree that commodities, if they haven't already turned, are likely to turn in the not-too-distant future. Where I would disagree is I don't think you play commodities through the commodity markets. Why? Every time you buy commodity futures, you're paying not today's price, but a future price. And if that future price is in line with the current spot price for a commodity, then you can roll your contracts for free from 1 month to the next. If the marketplace is pricing the forward contracts at a premium, then every time you sell the current month and buy the next month, you're paying up. That's called a roll yield, a negative roll yield. It's a negative roll yield because you have to pay up, meaning that you're earning a negative return on your contract rolls. Well, time passes, and so you have to roll your contracts. If you're paying a negative roll yield, then that means that your return on commodities is disappointing. Case in point, at the low for energy prices, when oil hit 27 a barrel, the forward price 1 year out was 42 a barrel. It was up 50%. That means you could have thought, gee, I think this is a bottom. I think oil is going up in price. And you could have bet on that. You could have bought oil futures. You could have had oil recover 40% in the next year and still lost money because it was priced in the forward market up 50%. It had to rise more than 50% in order for you to profit on that trade. So that's the problem with investing in commodities. Investing indirectly in commodities by investing in emerging market stocks and bonds is a very interesting alternative way to play the inflation cycle and the commodity cycle.
Rob, let me close with something different today. We've covered where we are now, risks to markets, opportunities, the turn in the value cycle, inflation, et cetera. But what has you worried? What has you concerned going forward?
I think the things that have me worried are we're overdue for a U.S. equity bear market. If we get an equity bear market, it'll have ripple effects across other asset classes. Even our own favorite asset classes would likely have a sympathy decline alongside U.S. equities. The other thing that worries me even more than that is the central banks losing credibility and losing control. Let's suppose that headline inflation already up to 2.3% in the last 6 to 8 months. Suppose it hits 3% in the next 6 or 8 months. All of a sudden, the central bank has lost control. The central bank can't keep interest rates down at zero when inflation is running around 3%. That winds up being a massive wealth expropriation from anyone with savings. And yeah, the government is intentionally engaging in wealth destruction for the affluent savers. That's the essence of negative real interest rates. But if you're trying to carry zero interest rates in a 3% inflation environment, it stimulates all sorts of crazy behavior on behalf of the general public and winds up defeating the core purpose of low interest rates, which is to stimulate the macroeconomy. So ironically, you could have the Fed's efforts to stimulate the economy with low interest rates having the unfortunate effect of stimulating hoarding instead of stimulating inflation in the macroeconomy, and you could have inflation get out of hand anyway, so that you wind up with the worst of both worlds, stagnation in the macroeconomy, outright recession, paired with renewed inflation, what's called stagflation. We had it in the 70s. It was brutal. That's a risk. I don't count it as a high risk or an imminent risk, but it's certainly possible. And if the Fed loses control, watch out.
Six-time Graham and Dodd Award winner Rob Arnott, Chairman of Research Affiliates. Thank you for joining us on King World News.